So if you haven't been following what's been going on since last Friday, and the Chancellor announcing a shed load of tax cuts in a time when actually our borrowing is at the highest, and also there's a lot of angst in the markets. The pound this morning, Monday morning, has been sliding massively against the dollar, which means basically if we are importing anything from America, which we do, it's going to cost us a lot more money than what it was last week. And it's to do with confidence in the government at the moment and the plan that the Chancellor announced on Friday. What does it mean to us in properties? What does it mean to us in the UK taxpayers as well as borrowers? Well, quite frankly, one of the biggest worry at the moment is you've got two arms of institutions in the UK doing two different things. They're not working in tandem. The Bank of England on one side is saying, look, we need to halt the amount of spending in the economy because inflation is rising. We need to kind of put a brake on those, and to do that, we have to increase interest rate. On the other side, you've got Quadruple has just given something like £100 billion worth of tax breaks across the board over the next few years, and that's the idea is going to trickle into the economy, and somehow people are going to get money out of that. The problem with that is if you get more money into the system, more spending, that means that money is chasing fewer goods. That will fuel even more inflation. And the challenge now is, what does it mean to us? Is because if that happens, the Bank of England will have zero, not even some choices, zero choice, but to use the one thing that they have in their armory to control inflation, which is interest rates. So by increasing the amount it costs people like you and I to borrow, and for example, for us in terms of buy-to-let mortgages or even mortgages, normal mortgages, residential mortgages, the idea is we'll have less money to spend on an everyday basis, and that's how we will try to reduce inflation. Now the problem is with us is in this budget 45% tax rate's gone, so the rich has just got richer. Something that's over £150,000 of earnings going to get £5,000. On the other side, somebody who's earning 20 or 30 grand is only going to get £500 of savings. So by increasing the tax funding by taxpayers for the rich, it's penalizing everybody else. So for you and I and everybody else who borrows in this country, it's going to get a lot more expensive. So last week, Bank of England went from 1.75 base to 2.25 base rate, which means the banks are borrowing for the Bank of England around that rate. So borrowing rate for us is going to go up even more. So at 2.25 bank base rate, that means the bank, a normal bank like a NatWest or any kind of mortgage banks, are going to charge us now around 3.5–4%, because they've got to make a margin from how much they're borrowing to how much they lend. So if that 2.25 now, and this morning on Monday morning they're talking about Bank of England, if Kwasi Kwarteng doesn't attenuate this plan, Bank of England will have no choice but to raise it by not 20.25%, not 0.5% like they've been doing, by a whole 1%. That means over the next month or so, we will jump from 2.25 to 3.25, which means our borrowing rate will go from somewhere around, let's say 2.25, so 4% to 5%. So somebody who's been borrowing recently, maybe bought a big house in southeast of England and borrowed loads of money 3 years ago at a fixed rate of around 1.25%, that could potentially, their mortgage could potentially go up 4 times by next month. So imagine if you're paying £1,000 today at 1.25 and your product comes off its fixed rate, that £1,000 could go up to £4,000 in 1 month. I mean, imagine the challenge that will happen in the housing market here. Not only for investors, but we're talking about normal borrowers here, people who are buying their own homes, who have bought their own homes. Their income has definitely not increased to that level. But having said, on the other side, their outgoings it will quadruple within almost the space of 3 months. So be very careful about, check if you're a buy-to-let lender, investor, check your portfolio, see where your challenges are, see which products are going to come off its fixed rate and when, and how much are you going to be exposed across your portfolio. That's the first thing. If you are a homeowner, check when your fixed rate is going to come off, and also what rate you're paying now. If you're 1%, you can price in at least, if it's 2 right now, if nothing happens right now, 2.25, that means your borrowing rate is going to go to about 3%. So you would have tripled the amount of money you spend on mortgages. And if it goes badly for us and Kwasi Kwarteng doesn't change anything that he's proposed last week, which politically is almost political suicide to go back and say, oh, actually, we made a mistake, we're going to change. But hopefully he will be the bigger person to do that. If he doesn't do that, the Bank of England will whack this 2.25 to 3.25, which means you and our borrowing rate might go up to 5%. So go back to, if you were borrowing at 1, that's an increase of 4 times on top of what you're paying. So let's hope for the best, but also right now this government seems to be driving in one direction, Bank of England driving the other direction. So that's really worrying for all of us. But let's see how they fix this, hopefully soon.